Okay, this is problem 29.1, and this is about what I call cash conversion cycle. They just call it cash cycle. But that's a really important concept, especially if you're ever running a small business, because you live on cash, not accrual net income. Accounting statements are done normally on an accrual basis. They can be done on a cash basis, but they're normally done on an accrual basis, which means they don't reflect the actual cash coming in and out of the company. And this cash conversion cycle gives you a sense of, from the time you start making a product, how much cash is invested, and then how long it takes you to collect the cash from the customer. Not sell it, but collect it. So the formula, I'm going to call it cash conversion cycle. This may not be exactly like is in your textbook. This way I think of it is days inventory plus days sales, or accounts receivable, some people would say, minus days payable, or AP, accounts payable, some people would say. So each of these is calculated a little bit differently, but days of inventory is normally your total inventory divided by cost of goods sold. It's hard to read, COGS, per day. And this is normally your accounts receivable divided by sales per day. And this subtraction here, it's important to note, this is a subtraction, is your accounts payable divided by cost of goods sold per day. So the same denominator here, and that equals your cash conversion cycle. So check your textbook to make sure they use this same formula. They may state it a little differently, but double check all this. But so basically this is just saying, let's just use some simple examples. Let's say your cost of goods sold every day. So in this case, these are annual statements, so we take that and divide it by 365. But let's just use a simple example. Let's say your cost of goods sold per day is $100. And your inventory is $1,000. Well, that means you have 10 days. That's the way, $1,000 of inventory and $100 of cost of goods sold per day. That means you have 10 days of inventory in your warehouse, on your books at any given time. Same process of accounts receivable. Again, we can just use a simple example. Let's say your accounts receivable, which is what customers owe you. In other words, you've made the sale, you delivered the product or good, but the customer hasn't paid you yet, would be, let's say you've got $2,000 of accounts receivable, meaning that's what customers owe you right at any given point in time, and that your sales per day, so in that case, we take that number for 2012 divided by 365, but let's just use some simple numbers again. Let's say your sales per day were 150, so that's 13.3 days of sales of accounts receivable, I prefer to think of it. Which the significance of this means if you want to create a product and sell it to a customer, you have to buy the product on average. You have to start accumulating the inventory 10 days prior to selling it. And then after you sell it, it takes on average 13 days to collect the money from the customer. So it takes 23.3 days from the time you make your product until the time you receive the cash for it. Now this last number, accounts payable, that's sort of the good news, is that typically when you buy some inventory, like this 10 days of inventory, well, the person or the company you buy the inventory may say, well, we'll deliver the inventory to you on day 0, but you don't have to pay us until day 5. And so you go through the same sort of calculation here, except using accounts payable. And that days payable benefits you because although you needed to have the inventory, in my little simple example, 10 days in advance, on your shelf, you didn't actually have to pay for it for, let's say in my example, 5 additional days. So in my little simple example, it'd be 10 plus 13.3 minus 5. So your total cash conversion cycle is 18.3 in my simple example. So when you think about it, you get cash from customer, you pay for inventory, then I'm using a dash line out here, you actually receive the inventory, let's say on day 0, but there's, in my example, there's 5 days here that you didn't have to, no cash went out the door. You got the inventory, but didn't have to pay anything. But then on this 5th day, you had to pay out the money. You take the inventory, you put it on your shelf. You, depending on the business, you may have to, make some changes. You may be buying raw material, but in any event, 13 days later, well, you sell the inventory on day 10 in my example, and then 13 days later, you get the cash from the customer. So this period of time, which is 18.3 days, is the cash conversion cycle. So it's just really important, especially for a small business, to understand this. Once you understand this, you start to see a couple of things. One, for the vendors who are selling you stuff, inventory, you want to try to negotiate as long a period of time as possible to pay them for that inventory. Conversely, for customers, you want to negotiate payment as soon as possible. But like everything, there's trade-offs. Customers, if you insist that they pay you immediately or within 5 days or 10 days, there may be some customers that don't want to do business with you because that's onerous on them. And so you sort of got to balance, well, if I give them better terms, they call it, meaning give them more time to pay, it hurts my cash conversion cycle and thus my cash flow, but I might get more total business. So anyway, that's the trade-off here, but I think with these formulas you can easily plug in and get the results you want. That's all.